So this is the third video in the series. This is the summary. We talked about how fees certainly impact yield, how expenses you incur impact yield. That was a little more obvious, like we talked about. So fees, how do you pay your advisors? Assets under management tend to get a pull on returns because managers aren't willing to take risk with their own livelihood. They're getting paid directly off those assets under management. Better for them to go out and spend their time, energy, and effort on growing their portfolio of clients with big chunks of money than it is to focus on small incremental growth in your portfolio. So how are you going to get your investment advisors' time focused on your portfolios? One of the key aspects of assets under management portfolios. When you're in fee for services, then the fee is a fixed item, and certainly the advisor wants to reduce their costs relative to that fee so their profit is larger. So make sure you're very clear about how they're going to spend the time and what they're going to do to earn that fee. Otherwise, you'll get what I call scope shrink. It won't creep because they can't bill you more. They'll actually shrink the scope of work that they do for you. So that's something to look at on fees. Expenses, remember we talked about expenses, things like due diligence costs inside private equity funds, litigation that flows through directly, anything borne directly by the investors means that the fund manager or the investment advisor has no skin in the game. Needs to have skin in the game, and Signal and the Noise, two great books on this topic for you to kind of review. But if they have no skin in the game, it's a direct misalignment of interest. And what you're trying to create is an alignment of objectives, where your objectives and your risk profile are directly aligned with the objectives and incentives for the investment advisor. So look out for those expenses that flow through directly to investors where the manager has no skin in the game. And alternatively, how do fees impact value? Because it's a continuum, right? Risk, return, and valuation are an embedded entanglement of ideas. And if you get your risk measurement wrong, you will get your valuation wrong. We looked at that with the CDOs and the housing bubble. 800% increase in the revenue generated in the CDOs by Moody's, certainly an incentive for them to keep that revenue stream coming in, right? So mismeasurement of risk often happens when it will impact our livelihood to measure it accurately. So again, Moody's had no skin in the game. That impacts your value and can get distort market values. So when you think linearly in risk and return, it's dangerous. You need to think dynamically in terms of risk, return, and value. I hope that's helpful. We'll see you next time.